In the middle of 2021, Michael Burry made a bet that the US bond market would go down, and over the following year, it fell over 30%. At the time, this trade didn't really get much media attention, because ultimately we don't actually know how much money he made on it, if anything at all. But the details don't really matter, because he was right. The bond market did fall. A lot. So it caught my attention when I saw this morning that Burry had made a bet against the US stock market. What confused me is that no one reporting on it actually seems to understand why he made this bet, when in fact it's actually kind of obvious if you know which place to look.
Yeah, I didn't think about that. That actually makes a lot of sense.
So let me paint a picture of how the man famous for predicting the housing collapse is now betting on the collapse of the entire stock market. You probably know Michael Burry because of The Big Short, a true story of how Burry, played by Christian Bale, predicted the collapse of the housing market before anyone knew it was coming. But that wasn't just an isolated bet made by a random person off the street. Burry was already a very successful asset manager well before his Big Short bet. An asset management company has the objective of growing clients' money. It's usually done by pooling funds from a number of clients and making large investments in a variety of assets, such as buying property, lending money to businesses, or trading stocks. Today he runs a firm called Scion Asset Management, which has pooled assets worth about $238 million. Every asset management company has different objectives and strategies for how they invest the funds. In Burry's case, he's mostly using the $200-ish million of assets under management to trade stocks. Stocks represent small ownership pieces of big corporations. Every weekday from 9:30 a.m. Eastern Time until 4 p.m., millions of people exchange their ownership pieces in companies. So pretty much all the time, there's a live counter for the price of each stock. And traders like Michael Burry buy and sell stocks to make profits from those price movements. But what if I told you there's a way that you can make money from a stock going up or down without actually owning the stock? It sounds like a scam, but it's actually a real thing. They're called options contracts, and they're kind of like side bets you can make on short-term stock price movements. Let me explain how it works. Let's say there's a company called Google, and its stock price is currently $100. So if you want to buy a piece of ownership of Google, you can for $100. But for this example, you don't actually want to own Google stock. And this could be for a variety of reasons. It could be because there's a lot of uncertainty about the future of the company, and you don't want to be exposed to that uncertainty. But you do want to make a bet. And that bet is that the stock will go up over the next 30 days. So instead of buying the stock yourself, you go and make a side deal with someone who does already own the stock. You write up a contract that says this: I get the right to buy your Google stock at $100 before the 15th of September, and in exchange for that right, I will pay you $5 today. The other person agrees, so you've just paid $5 today for the option to buy Google stock at $100 per share at any time over the next 30 days, regardless of how the actual stock moves in the market. Over the next 2 weeks, Google stock rises to $120. This is fantastic because you have a contract that allows you to buy Google stock for $100. So you can exercise that contract, buy the stock for $100, and then turn around immediately and sell the stock on the public markets for $120. Once you take into account the $5 that you spent to buy that option contract, you've made a tidy $15 profit, all without actually owning Google stock at all. What I just described is a call option. It's a financial contract called a derivative that gives you the right, but not the obligation, to buy a stock at an agreed price before an agreed expiry date. You were not forced to buy Google stock at $100, but you bought the option to do so if you wanted to. So, for example, if Google stock didn't go up to $120, but instead fell down to $80, your option contract would be worthless. Because who would want the option to buy Google stock at $100 if it's currently available in the public markets for $80? In that case, the contract would expire worthless, and in total you would have lost $5, the price you paid for the contract. So you did lose money, you lost $5. But if you, instead of using options contracts, had just bought Google stock at $100 and watched it fall to $80, you would have lost $20. So the options contract in this case allowed you to limit your downside to just a $5 loss. So that's a call option. But Burry actually did something different, something called a put option. A put option is basically the opposite of a call option. Instead of a contract that gives you the right but not the obligation to buy a stock at an agreed price before an agreed expiry date, it's a contract that gives you the right but not the obligation to sell a stock at an agreed price before an agreed expiry date. Put options are used when you want to bet that a stock will go down. And it works like this. Using the same example, Google stock at $100, but this time you think the stock will go down to $70 over the next 30 days. So you buy a put option, and this time the contract says, I get the right to sell you Google stock at $100 before the 15th of September, and in exchange for that right, I will pay you $5 today. The other person agrees, so you've just spent $5 today to buy the option to sell Google stock at $100 anytime over the next 30 days. 2 weeks go by and the stock does fall to $70. Again, this is great news because you have a contract that allows you to sell the stock at $100. So you buy Google stock on the public markets for $70 and then you exercise your put option contract that allows you to sell the stock for $100 for a tidy $25 profit once you take into account the $5 you spent on the contract. It's okay if you still don't exactly understand how these contracts works, but what was revealed this week was that Michael Burry is using put option contracts in order to bet that the US stock market is going down. During the second quarter of 2023, he bought put option contracts to bet against 2 million shares of SPY stock and another 2 million shares of QQQ stock. But SPY and QQQ don't represent investment in individual stocks or individual companies. They're actually index funds. They're essentially a stock that allows you to trade the entire stock market all at once. Can you imagine if you wanted to bet on the stock market going up, for example, and you had to buy every single stock individually and then sell them all individually if you wanted to get out of that trade? That would be incredibly annoying. So you don't have to do that. You can just use an index fund, like SPY, for example, which tracks the 500 biggest companies in the US and represents about 80% of the value of the entire stock market. So even though it's only 500 companies, it's basically a way to bet on the entire stock market. So what's QQQ then? Well, QQQ tracks the 100 biggest companies listed on the NASDAQ stock exchange. The NASDAQ is kind of like the New York Stock Exchange's cooler younger brother. All the tech and internet companies that you probably know are listed there. So QQQ is 100 of the biggest techie internet-based companies. It's really important to understand that Michael Burry isn't just betting that the stock market is going down, but he's also specifically betting that the tech-related companies of the stock market are going down. And it's going to play an important role when we talk about why it's likely Burry thinks this trade will work. But first, how do we even know about this trade? Wouldn't people like Burry and firms like Scion Asset Management want to keep their trades close to their chest, away from competition? Well, we know Burry made this bet all thanks to the SEC. The Security and Exchange Commission is the government agency that regulates asset management firms like Burry's Scion Asset Management. If a firm has more than $100 million of assets under management, they have to report a lot of details about their investments. One of those reporting requirements is filling out a 13F form every 3 months. And in that form, they need to provide a snapshot of the firm's stock portfolio. So every 3 months, we get to see what's in Burry's portfolio. Any anything that's new in the 13F that wasn't in last quarter's 13F has to be a trade that was initiated in the last 3 months. For example, in the latest 13F filing that was released today, we can also see that Burry invested in a lot of new stocks, and he also sold all of his bank stock investments as well. But by far the most interesting trade during the quarter is the bet against the US stock market. And as I said in the introduction, once you see a report that I found back in May, you'll understand why it actually makes a bit of sense. On the 17th of May 2023, S&P Global Market Intelligence analyzed the returns of S&P 500 stocks and found something pretty astonishing. From the beginning of 2023 until May 16th, the 500 biggest stocks in the US had collectively had prices rise by about 7%. Remember, the S&P 500 is a reflection of about 80% of the total stock market. So essentially, the total stock market in the US has risen about 7% in 2023 so far. That's a fairly strong start to the year, but it's also fairly in line with historical returns. What is unusual, however, is some of the specific stocks and how they contribute to the overall market's performance. S&P Global found that just 7 companies were responsible for all the gains in 2023. Apple, Alphabet, Meta Platforms, Microsoft, Nvidia, Amazon, and Tesla. Those 7 stocks accounted for more than 110% of the S&P 500's 2023 gains. Yes, that's right, more than 100% of the gains. Meaning if we exclude those 7 companies from the stock market would be down this year. In fact, it would be down 0.8%, but instead, because of those 7 companies, the market is up 7%. And it should be noted that those 7 companies do contribute about 26% of the size of the entire S&P 500, so it shouldn't be surprising that the performance of those 7 companies or those 7 stocks contributes in a meaningful way to the overall market. But to contribute 110% of annual returns requires huge individual performance. Tesla, Amazon, Alphabet all up 35%, Microsoft and Apple up 30%, Nvidia was up 100%, and Meta Platforms up 98%. So this begs the question, why? What's different about these 7 companies from the rest of the market? Why is their performance so different from the rest of the US stock market? And it has everything to do with the buzzword of 2023, AI.
There is an AI app for that.
ChatGPT has become the talk of the town.
AI.
Artificial intelligence.
Generative AI.
What do you think the future of this really is in terms of what the
Artificial intelligence has exploded in popularity in 2023, starting with the rise of ChatGPT, which received a $10 billion investment from Microsoft in January, followed by the launch of another AI language model called Bard, owned by Google, whose parent company is Alphabet. And the S&P 500 leader this year is Nvidia, a semiconductor company whose computer chips are the most popular choice for companies building language models like ChatGPT. Are you starting to see the pattern? These 7 companies aren't random. They all have announced massive AI-related projects in 2023. But you might be wondering, how do people know that these 7 companies are going to make more money from AI or the announcements related to AI? And even if you believe that they can make more money from AI, how do people know or how do people quantify how that's going to affect the value of these companies? Well, people don't know. But not knowing something has never stopped people from speculating, from guessing, from gambling. From the beginning of time, humans love to jump on the next hot thing. They always want to be ahead of the curve, and the stock market is no different. So what do we call it when a stock or a group of stocks rise for no particular reason other than speculation, euphoria, gambling? A bubble. Michael Burry likely thinks the recent increase in the stock market is at least partly an AI bubble. And since all of the stock market returns this year are from those 7 stocks, by betting against the whole market, he's basically betting against those 7 stocks. Also, remember how I said it's really important that he's also betting against QQQ, the top 100 NASDAQ companies? Well, guess which companies are the biggest on that exchange? Apple, Microsoft, Amazon, Nvidia, Meta, Alphabet, and Tesla. But despite knowing all of this, I personally have absolutely no interest in following Burry into this trade. Firstly, the information that we have from the 13F filings about Burry's trades have and come with several limitations. The filing shows Burry's investments at the end of the second quarter, the 30th of June. That's because asset management firms can wait up to 45 days until the end of the quarter to file the form. So anytime during the last 45 days, Burry could have closed and ended this trade, and we wouldn't know about it. We also never knew the strike price or the expiry date of the options that he was buying. Options contracts can have expiry dates as short as 1 day or as long as multiple years. Those are called leaps. And since Burry has a history with very short options contracts, it's entirely possible that the trade has already come and gone. But beyond the informational limitations, I also just don't like short-term macro bets. Even though I agree with the premise that stock market returns in 2023 are likely being fueled by an AI bubble, that doesn't mean the market must go down. Bubbles can go on for years without popping, so to expect a sudden reversal in AI-related stocks is a long shot in my view. But that's the kind of bet that Burry sometimes likes to make. A small bet that would have a huge payoff if he's right. Now all we need is Burry to reactivate his Twitter and tell us about the trade himself.